Overview of business combinations. Business combinations occur when one company obtains control over another entity. Under IFRS, business combinations are not differentiated by legal structure, whereas U.S. GAAP traditionally categorizes them as mergers, acquisitions, or consolidations. Regardless of structure, modern accounting standards require the acquisition method, which replaced the older pooling of interests approach. The acquisition method focuses on identifying the acquirer, measuring the consideration transferred, and recognizing acquired assets and assumed liabilities at fair value. The objective is to present the combined economic entity as a single reporting unit. Understanding business combinations is critical because acquisitions can significantly alter a company's assets, liabilities, earnings, and financial ratios. Acquisition method and balance sheet effects. Under the acquisition method, the parent company consolidates 100% of the subsidiary's identifiable assets and liabilities, regardless of the percentage ownership acquired. The subsidiary's separate equity accounts are eliminated during consolidation because they are replaced by the parent's investment and ownership interest. If the acquisition is financed with cash, the parent's cash balance decreases by the amount paid. The resulting consolidated balance sheet therefore reflects the combined resources and obligations of both entities. This treatment differs significantly from the equity method, where the investment is reported as a single-line asset rather than incorporating the subsidiary's individual assets and liabilities into the parent's balance sheet. Non-controlling interest on the balance sheet. When the parent owns less than 100% of the subsidiary, the portion not owned by the parent is recognized as non-controlling interest, minority interest. Although the parent may own only a majority stake, it still consolidates all subsidiary assets and liabilities because it controls the entity. Non-controlling interest represents the claim of outside shareholders on the subsidiary's net assets and is reported within shareholders' equity. The amount is generally calculated using the percentage of ownership not acquired multiplied by the subsidiary's equity or fair value, depending on the accounting approach. This treatment ensures that consolidated financial statements accurately distinguish between parent ownership and external ownership interests. Income statement consolidation. The acquisition method affects not only the balance sheet but also the income statement. Under consolidation, the parent reports 100% of the subsidiary's revenues and expenses rather than merely recording its ownership share of earnings. Revenues and expenses of both companies are combined line by line, and intercompany transactions are eliminated to avoid double counting. This approach contrasts with the equity method, under which the parent reports only a single line called equity income. Consequently, consolidation results in substantially higher reported sales and operating expenses, providing a more complete picture of the scale of operations controlled by the parent company. Non-controlling interest and net income. Because consolidated financial statements include 100% of the subsidiary's revenues and expenses, they must also recognize the portion of earnings attributable to minority shareholders. Non-controlling interest in earnings is calculated based on the ownership percentage not held by the parent and is deducted in arriving at net income attributable to the parent shareholders. Although revenues, expenses, assets, and liabilities are higher under consolidation, total net income attributable to controlling and non-controlling shareholders combined remains economically consistent with alternative accounting approaches. Analysts should carefully distinguish between consolidated earnings and earnings attributable solely to the parent when evaluating profitability and shareholder returns. Goodwill recognition and measurement. Goodwill arises when the purchase price paid in an acquisition exceeds the fair value of the acquired company's identifiable net assets. It represents future economic benefits from factors such as customer relationships, brand value, synergies, skilled workforce, and market position that cannot be separately identified or measured. During acquisition accounting, identifiable assets and liabilities are first adjusted to fair value. Any remaining excess purchase price is recorded as goodwill on the consolidated balance sheet. Goodwill is considered an unidentifiable intangible asset and cannot be sold separately from the acquired business. Therefore, its valuation and subsequent monitoring are important areas of financial statement analysis. Full goodwill versus partial goodwill. A major difference between IFRS and U.S. GAAP involves goodwill measurement. U.S. GAAP requires the full goodwill method, under which goodwill is based on the fair value of the entire subsidiary, including the non-controlling interest. IFRS permits either the full goodwill method or the partial goodwill method. Under the partial goodwill method, goodwill is measured only on the parent's acquired ownership share. As a result, both goodwill and non-controlling interest are lower under the partial goodwill approach. Consequently, total assets and total equity reported on the consolidated balance sheet are higher under the full goodwill method. CFA candidates should understand these differences because they affect comparability across firms and reporting frameworks. Goodwill impairment and analytical implications. Unlike most intangible assets, goodwill is not amortized but must be tested regularly for impairment. Under U.S. GAAP, impairment exists when the carrying value of a reporting unit exceeds its fair value, requiring measurement of the goodwill loss. IFRS applies a one-step impairment approach based on the recoverable amount of the cash-generating unit. If impairment occurs, goodwill is written down and a loss is recognized in earnings. In rare situations where the acquisition price is below the fair value of identifiable net assets, a bargain purchase gain is recognized immediately in income. Analysts should monitor goodwill balances closely because future impairments can materially reduce earnings and equity.